In late 1986, in an unfinished commercial building in Sacramento, California, a construction site was assembled for a single purpose. ZZZ's best signage was hung. Materials were staged. Work that appeared to be in progress was arranged across the floor. The building did not belong to ZZ's best, and no restoration contract for it existed. When the engagement partner from Ernst & Winnie arrived to tour the site, he walked the floor, observed what appeared to be a large-scale insurance restoration job, and left satisfied that the work was real. Before that visit, the auditors had signed a confidentiality agreement that barred them from independently contacting the parties who supposedly commissioned the work. The question this episode answers is structural. How does a company fabricate the majority of its revenue and pass an audit? And what precise accounting arrangement made the fabrication auditable in the first place? The mechanism at the center of ZZZ's best was not the carpet cleaning business. That business was real, small, and largely legitimate. The mechanism was a second invented line of business layered on top of it: insurance restoration. Insurance restoration is a real industry. When a building suffers fire, flood, or smoke damage, an insurance carrier engages a restoration contractor to repair and clean the affected property. The contractor bills against the insurance claim. These jobs can be large, they can span multiple sites, and the paperwork flows through insurance adjusters and third-party claims administrators rather than the property owner directly. That indirection is the structural feature that matters. In a normal restoration engagement, the contractor's counterparty is not a customer walking through the door. It is an insurance intermediary, and the contract documentation is generated by that intermediary. Barry Minkow's design exploited exactly this feature. The record establishes that ZZZ's best claimed to be performing enormous restoration contracts sourced through an insurance adjustment company. The revenue recognized from these contracts did not depend on a retail customer who could be interviewed, a storefront that could be visited, or a service that produced a physical trace anyone could inspect after the fact. It depended on documentation that ZZZ's best itself, working with confederates, could generate. Legitimately, revenue recognition for a long-term contract requires that the revenue be earned and realizable, supported by evidence of an actual obligation performed for an actual counterparty. The auditor's job is to obtain sufficient competent evidence that the transaction occurred. For a restoration contract, that evidence would ordinarily include the contract itself, the insurance claim it references, confirmation from the insurer or adjuster, and physical verification that the work was performed. The fraud inverted this. Rather than the business generating documentation, the documentation generated the business. ZZZ's best produced restoration contracts on paper, booked the revenue, and then constructed whatever physical and testimonial evidence was needed to satisfy anyone who asked. The insurance restoration segment grew until it represented the overwhelming majority of reported revenue. By the time of the company's public offering, the restoration business was the company. The carpet cleaning was a rounding error. What made this auditable rather than immediately transparent as fiction was the layered indirection of the insurance model combined with two devices ZZZ's best imposed on its verifiers. First, confidentiality agreements. Second, controlled site access. Both were presented as ordinary features of the insurance restoration industry, where client privacy and building security are plausible. Both functioned to sever the verification chain at exactly the points where fabrication would otherwise be exposed. Now, the architecture. The public record, including the SEC's enforcement findings, establishes how the structure was built and operated. Step 1. The invented counterparty. ZZZZ. Best represented that its restoration contracts came through an insurance adjustment intermediary. This intermediary supplied the paper. Confederates of Minkow operated in this role, generating documentation for contracts that had no underlying reality. Because the auditors and investors' point of contact for verification was this intermediary rather than an independent insurer, the person confirming the contract's existence was the same interest fabricating it. Step 2. The fabricated documentation package. For each purported job, a set of records was produced. Contracts, confirmations, descriptions of work scope and dollar value. Individual restoration jobs were represented at very large figures, some in the millions of dollars. Because restoration of a major fire or flood loss can legitimately reach such figures, the amounts did not signal fabrication on their face. The record shows that the aggregate of these fictitious contracts drove reported revenues into the tens of millions and, by the company's collapse, the total fraud is measured in the range of $200 million of value destroyed against a business whose real operations were minor. Step 3. Neutralizing physical verification. This is where the Sacramento site enters. When Ernst & Winnie sought to verify that a large restoration job actually existed, ZZZ's Best could not simply refuse. A refusal would itself be a red flag. Instead, the company arranged a controlled demonstration. It located a building under construction, obtained access, hung its signage, and staged the space to resemble an active restoration site. The engagement partner toured this site and recorded that work appeared to be underway. The record establishes that the building was not a ZZZ's Best job at all. It was a set. Step 4. The confidentiality agreement as a verification block. Before the site visit, ZZZ's Best required the auditors to sign a confidentiality agreement. The stated rationale was the sensitivity of the insurance restoration business and the privacy of the parties involved. The structural effect was different. It barred the auditors from independently contacting the insurance carriers, building owners, or other third parties who could have confirmed or denied the existence of the contracts. The one verification step that would have collapsed the fraud, an independent confirmation with a genuinely unaffiliated party, was contractually foreclosed. The auditor's confirmation procedures were channeled back through the very intermediary controlled by the fraud. Step 5. Capital recycling to create the appearance of collections. A fabricated contract produces fabricated receivables. Fabricated receivables must eventually appear to be collected, or the aging balances raise questions. The record shows ZZZ's Best raised outside money through its public offering and through borrowings, and used incoming cash to simulate the payment of prior fictitious contracts. This is the structural signature of the scheme. New capital does not fund operations. It funds the appearance that earlier fictions were real. The business was consuming cash to maintain the illusion that it was generating cash. Assemble the org chart. At the center, ZZ's Best, a public company with a small real business and a vast fictional one. Adjacent to it, an insurance adjustment intermediary controlled by Confederates supplying documentation. Around them, the fabricated restoration sites, either staged or entirely paper. Above them, the auditors and investors, whose verification pathways were routed exclusively through the controlled intermediary and the stage sites, and contractually barred from stepping outside that loop. why did detection fail, and fail for as long as it did? This is a structural question about the verification chain, not a question of individual competence. The first failure point is the confirmation procedure. Auditing standards require the auditor to gather evidence from sources independent of the client. For accounts receivable, this ordinarily means confirming balances directly with the debtor. For the restoration contracts, the debtors were insurers and adjusters. The confidentiality agreement accepted by the engagement team meant that confirmations did not reach genuinely independent parties. They reached the controlled intermediary. When the source of confirmation is captured by the party being audited, the confirmation procedure produces evidence of nothing except the fraud's willingness to confirm itself. The record establishes that this was the decisive breach in the verification chain. The second failure point is physical inspection. Touring a site is intended to substitute direct observation for reliance on documents, but observation only verifies what it can distinguish. The engagement partner could observe that a building existed and that it appeared to contain restoration work. He could not observe from a controlled walkthrough whether ZZZ's Best held a contract for that building, whether an insurance claim underlay it, or whether the company would ever be paid. The staged site satisfied the form of physical verification while conveying none of its substance. The observation confirmed a building, and the fraud was in the contract. The third failure point is analytical. The restoration business grew at a rate and to a scale that outpaced any plausible operating capacity for a company of ZZZ's Best size and history. A carpet cleaning operation does not organically become a restoration contractor booking multi-million-dollar jobs across multiple states in a compressed period. The margins reported were inconsistent with the economics of the real industry. These are the analytical signals that a fabricated revenue line tends to emit, because fabrication is not constrained by the physical limits of real operations. It grows as fast as the paper can be produced. For detection to have occurred earlier, one thing would have had to be true. The verification chain would have needed at least one link that the fraud did not control. A single independent confirmation with an insurer that was not a confederate would have returned no record of the contract. A single unannounced visit to a purported site outside the staged demonstration would have found no ZZZ's Best work. A single refusal to accept the confidentiality agreement as a substitute for independent verification would have forced the fraud into the open. The scheme survived precisely as long as every link in the chain ran through parties the fraud controlled. The unraveling did not begin with the auditors or the SEC. It began with the receivables side of the recycling machine. The record establishes that the collapse traced first to consumer complaints and to credit card fraud in the small, real carpet cleaning business. Overbilling on customer credit cards drew attention. That attention brought press scrutiny. In 1987, the Los Angeles Times published reporting that questioned the credit card practices and, in doing so, cast doubt on the company's broader representations. Once the reporting appeared, the mechanism began to fail from the outside in. The failure was structural. A fraud sustained by recycled capital depends on continued access to new capital and on continued confidence that the receivables are real. Adverse press directly attacked confidence. As confidence eroded, the company's ability to raise and roll capital eroded with it. The receivables that had been serviced with incoming cash could no longer be serviced, because the incoming cash stopped. The verification block then reversed against the company. The same restoration contracts that had been shielded from independent confirmation now had to be defended under scrutiny. When outside parties began attempting to verify the existence of the jobs could not be found. The staged sites did not correspond to real contracts. The insurance intermediary that had supplied the documentation could not withstand independent examination. Ernst and Winnie ultimately withdrew from the engagement. The record shows the auditors came to recognize that the restoration business they had reported on did not exist as represented. The company entered bankruptcy in 1987. The SEC brought enforcement action. The record establishes that the reported restoration revenue was fictitious, that the contracts were fabricated, that sites had been staged for the auditors, and that outside capital had been used to simulate the collection of invented receivables. Barry Minkow was convicted on multiple counts of fraud and related offences and received a substantial prison sentence. The public company that had, at its peak, carried a market valuation of hundreds of millions of dollars was revealed to rest on a business that never performed the work it billed. What does ZZZ's best establish as a structural matter? It establishes that the vulnerability was not in the carpet cleaning and not in the fabricated documents themselves. It was in the verification architecture. A fraud that controls every counterparty a verifier is permitted to contact can produce confirming evidence at every step, and each confirmation compounds the appearance of legitimacy rather than testing it. The confidentiality agreement was the load-bearing device. It converted the auditor's independent confirmation, the single most important safeguard against fabricated receivables, into a procedure routed entirely through the fraud. The case became a fixture in the reform of auditing practice around related party transactions, third-party confirmations, and the auditor's obligation to obtain evidence from sources genuinely independent of the client. It stands in the audit literature as a demonstration that physical observation and documentary confirmation are only as strong as the independence of their sources. When a client can supply both the documents and the parties who confirm them, and can stage the sites that are inspected, the auditor is not verifying the business. The auditor is touring the fraud.